check the group description, you'll be able to get the past paper for November 2017. You'll see a link there as past papers. You go check November 2017, you'll be able to find it. So, or someone can be able to share here. Someone can share there, or so that Sahara can be able to get access. So the question says, Revision Limited is a mid-sized firm selling electronic keyboards, both on cash and hire purchase terms. So the following information has been extracted from the firm's books of account as at 30th of September 2017. So you have the share capital, general operating expenses, cash balance, or cash recovered from hire purchase customers. We have the cash sales. We have hire purchase trade receivables at the start of the year. Then we have property, plant, and equipment. We have accumulated depreciation. So for the property, plant, and equipment, we have retained earnings at the start of the year. We have provision for unrealized profit at the start of the year. Then you have purchases, 171,000. We have trade payables, 40,000. Then inventory at the start of the year. We have the inventory at the start of the year, which is actually 7,500. So the company's policy is to take credit for gross additional information. The number one, the company's policy is to take credit for gross profit, including interest for hire purchase sales in proportion to the cash collected. So it does this by raising a provision against the profits included in the hire purchase trade receivables not yet received. So it means here they actually provide for unrealized profit. So they make a provision against the profit included in the hire purchase trade receivables, which are yet to be received. So they actually, in this case, make a provision for unrealized profit. So then the cash selling price is fixed at 50%, and the hire purchase selling price is actually 80% respectively, against the cost of goods purchased. Then we have the next one there. So the next one there says, so the hire purchase contract requires initial deposit of 20%. Initial deposit of 20% of the hire purchase selling price. The balance to be paid in 4 installments at quarterly intervals. The first installment is due in 3 months after the agreement is signed. So the hire purchase sales for the year amounted to 270,000, including interest. Depreciation is provided. Depreciation is actually charged on property, plant, and equipment at the rate of 15% per annum on cost. 1/3 of the depreciation relates to what cash sales. The operating expenses are to be apportioned on the basis of cash and hire purchase sales. So you are required to prepare a Revision Limited income statement for the year ended 30th of September 2017, showing separate columns for cash, hire purchase, and the combined sales. So this means this company is actually involved in 2 kinds of sales. We have the cash sales, and of course you have the hire purchase sales. That's why in this case, they want you to be able to show the 2 columns, that is for cash, and of course hire purchase, then you get what the combined sales. Then at the end of it all, you need to, for example, provide, in this case, Roman number 2, the statement of financial position as of 30th of September 2017. So of course, yesterday, in this case, when we were looking at the sales method, we said that you'll likely be called upon, maybe in this case, to be able to find out what are the debtors of this particular kind of entity. So under the sales method, you must find out, for example, what are the debtors. In any case, there was actually any repossession that was actually done. You need to, for example, find out or prepare the repossession account. Then, of course, in this case, there's, of course, the unrealized profit on the amount which are actually yet to be recovered from the customers who have actually purchased on hire purchase. You'll have to compute the unrealized profits. Unrealized profit, or profit which is actually not actually realized, when in this case, they are made actually the sales on hire purchase. They are made the sales on hire purchase. So we can commence by having to do a few workings here. So the workings, we can do a few workings here before we start having to prepare those statements. So the workings. So if you look at the number 2, you are told the cash selling price is fixed at 50% and the hire purchase selling price at 80% respectively against the cost of goods purchased, So of course, now in this case, the cash sales, you can see the cash sales in the trio balance. So of course, the cash sales, you can be able to see them in the trio balance is actually 36,000. So the cash sales, is actually how much? 36,000. Is actually an amount of 36,000. And of course, you are told the cash selling price is fixed at 50%. Selling price is fixed at 50%, the hire purchase selling price 80% respectively against the cost of goods purchased. So it means that these amounts, they have already been able to include an amount of 50% over and above the cost of sales. And of course, now in this case, the cost of sales will likely be at 100%. So it means this 36,000 is actually 150%. Exactly 150%. And in this case also, they have actually been able to indicate the hire purchase. Of course, the hire purchase sales, you've been told in the additional information there, it is actually 270,000, including what? Including interest. I think it is a note number, is it 4? Is it 4 or 5? Is it note number 4? So the hire purchase sales is actually 270,000. So already in this hire purchase sales, they have already been able to include an amount over and above the cost of sales of 80%. So it means this 270 is actually at 180%. Exactly at 180%. So, and of course, now in this case, when we'll be coming up now in this case with the statement of profit and loss, in this case, we'll be required, for example, to be able to determine what could be the cost of sales. Because in this case, the difference between now, in this case, the sales and the cost of sales will be able to give us the gross profits in the income statement. So with this, then you can actually easily be able to determine what the cost of sales, because already you've been told the cash selling price is fixed at 50% and the hire purchase selling price at 80% respectively against the cost of goods purchased. So for us in this case, since we are preparing two income statements for the cash sales and of course for the hire purchase, we can easily in this case be able to determine the cost of sales, because our cost of sales in this case will likely be at 100%. So the cost of sales regarding in this case, both will likely be at 100%. So it means, of course, for us to be able to get 100%, we have to determine the value of x. The value of x. So it means in this case, you can be able to do the computation here. So you can say in this case, you normally do what? Is it cross multiplication or something? So if in this case, 180% is equals to this, what about 100%? So you'll be able to take 100, so multiply by 270,000, you divide by 180. So I don't know how much you're having to get. Then this one, you do the same. You take 100, multiply by 36,000, you divide by 150 for us to be able to get what? The cost of sales. For us to be able to get the cost of sales under the sales, the cash sales, and of course, cost of sales under the hire purchase. So what is the value in this case when you compute this one? What is the value you get when you compute that one? It is November 2017, question number 5B, Elizabeth. What is the value of the cost of sales regarding the cash sales when you compute this one? When you do the computation. When you do the computation, what is the value of the cost of sales for the cash sales and of course for the hire purchase? So I can see cash sales, you're having to say it is actually 24,000. It means it is actually 24,000. 24,000. What about the hire purchase? The cost of sales for the hire purchase? For hire purchase, I can see you're saying 150,000. 150,000. So it means when you'll be coming up with the income statement, to get the GP, we don't have to go into the hullabaloo of taking opening stock plus do what and what. To get the GP here, we'll just take this amount, we minus this particular amount, we'll be able to get what? Our GP. We'll likely be able to get our GP gross profit in the income statement. We'll also take under hire purchase, we'll be able to take this amount, we minus this one, we'll be able to get our GP. We'll be able to get our GP. Then so we can come up with this case with our debtors account. We can come up with our debtors account. So with our debtors account, with our debtors account, with our debtors account. So of course, if you look at the trio balance, the balance brought down regarding debtors, you've been told that the hire purchase trade receivables in the trio balance, the hire purchase trade receivables is an amount of 1134. Then of course, now in this case, of course, these debtors we are talking about, they are those you're having to sell to goods on hire purchase. They're those you're having to sell to goods on hire purchase. So we are expecting them to pay in installments. They become what? Our debtors as an entity. So those sales that we actually made to these particular debtors on hire purchase, we already have them here, is this amount. So the sales we actually made to them during the year is actually 270. Is it million? I think 270 million. 200, because our figures are actually in thousands. So they're actually in thousands. Our figures are actually in thousands. So we already, in this case, made sales to them during the year of an amount of 270,000. But of course, you have to determine whether these hire purchase debtors have actually been able to pay us any amount during the year. So if you look at the trio balance, any amount cash recovered from hire purchase customers. So you can see it there, cash recovered from hire purchase customers. So of course, they were our debtors, but during the year, there's an amount, in this case, we ended up having to recover from them. So the cash received from debtors during the year is an amount of 157,734. So that is this amount is actually in the trio balance. You can be able to see it on the credit side. So we made sales to them worth 270. This one is an additional information. This one is in the trio balance. What you've already been able to recover from them during the year is actually an amount of 157,734. So therefore, in this case, regarding by the time we are coming to the end of the year, what amount will we be actually claiming from these debtors? The credit purchase, the hire purchase. What amount will we actually be claiming from these debtors? So you can get the balancing figure there. I think this one is 271,134. So 271,134. If you minus, what do you get? If you minus 271,134 to get the outstanding amount on the hire purchase sales. To get the outstanding amount on hire purchase sales, how much are you having to get if you minus 271,134 minus 157,734? I can see T says 113,400. 113,400. So that is the amount outstanding. The amount outstanding by the end of the year from the hire purchase customers. So we made these sales to them. They have paid this. This is what they had as a balance at the start. By the end of the year, we are claiming from them an amount of 113,400. But of course, out of this amount that is actually outstanding, then we are supposed in this case to know what is actually the unrealized profit. And of course, if you can be able to recall, when we are looking at the computations we end up having to make, we said that in this case, to be able to determine the unrealized profits, under the sales method, the unrealized profit under the sales method from the debtors, the profit we haven't been able to recover by the end of the year. So you'll likely be able to take the outstanding amount. You take the outstanding amount in this case, you actually divide by the higher purchase sales. The higher purchase sales, you multiply by the gross profit. You actually multiply by the gross profit. You 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 multiply by the gross profit. The gross profit. So of course, the amount outstanding there by the end of the year, the amount outstanding there by the end of the year, so is actually 113, 400. So can we put this amount outstanding? So it will be 113,400. You divide by the higher purchase sales, which are here, 270, these ones, 270,000. You multiply by the gross profit. So how do you get the gross profit? The gross profit, we've already been able to say, you know the formula. You normally take the sales. You take the sales, you minus the cost of sales. You normally take the sales, you minus the cost of sales. You normally take the sales, you minus the cost of sales. So it means that in this case, our gross profit here will likely be an amount of 120,000 on the higher purchase sales. That is the gross profit on the higher purchase sales. So the gross profit on the higher purchase sales is this one. But out of these sales we are talking about, there's an amount which you haven't been able to recover. So you haven't been able to realize this particular profit by the end of the year. So it means in this case, we'll have to be able to do what? Consider it. So it will be the outstanding amount divided by the higher purchase sales, which are these ones. You multiply, in this case, by the gross profit. So of course, the GP here is equals to the 270,000. You minus the cost of sales, which is actually 150,000. And of course, you'll be able to get an amount of 120,000, which is actually here. So of course, what do you get when you do the computation? What is the unrealized profit? What is the unrealized profit? So we don't actually do the computation of unrealized profit on the cash sales, because the cash sales you've actually been able to, when you sell on cash, you get the money. So you get the money, you've realized all the sales here. But in this case, there's this amount you haven't been able to recover when you are selling on higher purchase. That is where there is unrealized. You haven't realized that profit because you are yet to recover the money. But on cash sales, how do you compute unrealized profit on cash sales? Yet you sold on cash basis. You've already collected all the money. There's no amount that is outstanding out there. But for, in this case, a higher purchase, there's still amount you're still having to claim out there. So there's unrealized profit. You don't actually do it on cash sales, only on higher purchase. So what is the amount you're having to get here? Exactly 50,400. 50,400. So this is actually 50,400. So that is the unrealized what profit. So in this case, when you likely be coming up with the income statement, because this profit you haven't been able to realize it by the end of the year, it means it's like an expense you're having to incur. So it will likely basically be part of the expenses when you are coming up with what, with the income statement. So still the same case here. It will likely end up having to affect, in this case, what, our balance regarding what, the outstanding debtors by the end of the year. Our balance regarding the outstanding debtors by the end of this one will end up having to minus from here when you're coming up with what, the statement of financial position. But that is what the unrealized profit. That is the unrealized profit during the year. The unrealized profit during the year. So with that, then in this case, let's, of course, there's other information you have actually been given. You've been told, for example, depreciation is charged on property, plant, and equipment at the rate of 15% per annum on cost. 1/3 of the depreciation relates to what? Cash sales. So when you'll be coming up with the two columns for the sales and for the higher purchase, in this case, we'll have to apportion. 1/3 of that depreciation should actually be able to go to what? In this case, the sales on cash basis. Then operating expenses are to be apportioned on the basis of cash and higher purchase sales. On the basis of cash and higher purchase sales. So we'll be able to, in this case, apportion those expenses by using the ratio of these cells. So 36 and 270. 36 and of course what 270. So you'll be able to add the two, then you use that ratio to do what, to apportion those particular what operating expenses. So you can now in this case come up with the income statement. Let's come up with the income statement for the two options, the cash sales and of course what the hire purchase sales. So Reja Limited, you can have Reja Limited. So Reja Limited. Reja Limited income statement. Income statement for the year ended. Income statement for the year ended. It is the year ended 30th of September 2017. So for the year ended 30th September 2017. For the year ended 30th of September 2017. So of course now in this case, we have the cash sales. Then we have hire purchase sales. Then in this case, we have the combined. Sales. So that is what they have called upon us to be able to prepare. So we'll have the hire purchase sales. And of course, now in this case, what the cash sales. So they have told us to prepare the three. So of course, now in this case, most obviously in the income statement, so our figures are actually in thousands. Our figures are actually in thousands. Like that. They're actually in thousands like that. So in this case, the sales, so the sales we've already actually been given. You start with the sales. You normally start with the sales. So of course, the cash sales are here, 36,000. The hire purchase sales are here, 270,000. Then you less the cost of sales. You less the cost of sales. And of course, the cost of sales are here, 24,000. And this one, 150,000. So with the difference now, in this case, you'll be able to get the gross profit. You'll get the gross profit. So this one is 12,000. This one is 120,000. This one is actually 120,000. So you can add to get the combined. You just add to get the combined. I think this one is 306. Is it 306? 306,000. This one is 174,000. Then this one is 132,000. I think 132,000. 132,000. So that will be the gross profit for the two. 132,000. Then in this case, we can end up having to minus any other expenses. We can actually end up having to minus any other expenses. So of course, in this case, they have talked about, in this case, what depreciation on PPE, depreciation on property, plant, and equipment. And as per the additional information there, they're having to say, in this case, we need to provide depreciation on property, plant, and equipment at the rate of 15% per annum on cost. So you can have a working, so maybe it can be working for, I don't know, you'll call it working for. So depreciation on property, plant, and equipment. So they have said 15% of, so the cost of, in this case, property, plant, and equipment is actually 50,000, So 15% of 50,000, I think you'll get a value of, this is 75, so you get a value of 7,500. And you've been told that in this case, for the cash sales, we'll apportion a third of this to go to the cash sales. A third of this to go to the cash sales. And of course, a third of this, I think it is 2,500. A third of this is actually 2,500. So with less depreciation of 2,500, yeah, the remainder is actually 5,000, which will likely go to, now in this case, the higher purchase sales, the higher purchase sales. Then there was profit which was not actually realized. There's profit which was not actually realized by the end of the year. So unrealized profit by the end of the year was actually 50,400, 50,400. But what you need to take note is that if you look at the 𝐿𝐴 balance, if you look at the 𝐿𝐴 balance there, if you look at the 𝐿𝐴 balance, you have to confirm whether in this case there was any unrealized profit at the start of the year, because this one will be carried forward to the coming year. It will open the coming year. But in this case, in our 𝐿𝐴 balance here, there is provision for unrealized profit at the start of the year. 1st of October 2016 was 504 shillings. So by the time they were starting the year, that is 1st of October 2016, there was a URP of an amount of 504. Then by the time they are coming to the end of the year, that is September, 30th of September 2017, there's an amount of, in this case, which we've computed here, 50,400. So in between here, there was actually what? An increment. In between here, there was an increment to lead to the balance having to be what? 50,400. So that increment is what will end up having to take as what? As the expense. As the expense. So what is the increment? So provision for unrealized profit, provision, unrealized profit during the year. So that increment is how much? That increment is how much? Because it's what they ended up having to incur during the year. That increment is what we'll be able to end up having to take as what? As the unrealized profits. You get the difference. How much are you having to get? The difference. How much are you having to get? So from 504 at the start of the year up to the end of the year, 50,400, which you've computed here. There was an increment of how much? There was an increment of how much? $49, I can still saying 49,891. Is it 49,891? Remember, this one is 504. I don't know whether you are looking at the question. So this is 504. This is 5,400. It can't be, or there's no one. There's no way one will appear there. It must be a figure of like 6 or something. It must be a figure of like 6 or something. I don't know. There's no way in this case one will actually appear there. There must be at least a 6. So it's 49,996 or something. 49,896. 49,896. We don't add, we minus, we get the difference because we want to know the increment. The increment is the expense you incurred during the year. So you don't add, but you get the increment. At the start of the year, this is what you had as a balance. What you incurred during the year made it to increase to this amount when you combine the two. So the increment during the year is what in this case we want you to be able to get. So I can see 49,896, 49,896. And remember that one is actually only having to affect what? The higher purchase sales. So it is not actually under cash. So 49,896, 49,896 will end up having also to do what? To deduct 49,896. So this one is 7,500 will deduct. Then any other expense we're having to see in this case, it is the general operating expenses as per the 𝐿𝐴 balance. The general operating expenses as per what? As per the 𝐿𝐴 balance. But for this one, if you look at note number 6, we've been told the operating expenses are to be apportioned on the basis of cash and higher purchase sales. So what it means by this, the general operating expenses, so the operating expenses, so they are apportioned on the basis of sales. They are apportioned on the basis of sales. What it means by this, for cash sales, you need to take this 36,000. You take 36,000 over the total, which is actually 306,000. You multiply in this case by those expenses. I think it is an amount of 65,000 is an amount of, is it 65,000? Yes. An amount of 65,000. You multiply by 65,000. What are you having to get? When you take 36,000, because they are apportioned on the basis of cells. So 36,000 over 306,000 multiplied by 65,000. So that we can be able to get those ones for the cash sales. So 36,000 over 306,000 multiplied by what we have as the general operating expenses should be able to give you what you should be able to apportion to the cash sales. What are you having to get as a figure there? I can see you're saying 7647. 7647. 7647. 7647. You're getting 7647. So 7647. So you get the difference, eh? You get the difference by minusing from 65,000. Just minus from 65,000 to get the figure here. So because the total here should actually be 65,000. So get the difference to get the figure there. The difference to get the figure there. So 65,000 minus 7647, 57,353. 57, I can just saying 57, 57,353, 57,353. So I think those are the expenses, unless you need to look at the tier balance. If there's any other expense, you can be able to consider it. But I think the others are assets and of course what liabilities. So no any other extra expense in this case we are coming across. No any other expense you are coming across. So there'll be those ones. So you can actually be able to get the difference. Get the difference. So what is the profit? What is the profit for cash sales? What is the profit for cash sales? What is the profit for cash sales? And of course, what is the profit for hire purchase sales? Cash sales, you take 12,000 minus the 2. I can just say 1853. 1853. 1853. What about the hire purchase sales? What about the hire purchase sales? What about the hire purchase sales? Hire purchase sales. What about the hire purchase sales? 7751. 7751. So you can add the two to get, or you can minus from this one. You can minus these ones from this one, or you can add the two. When you add the two, what are you getting as the total combined profit? What are you getting as the combined profit? What are you getting as the combined profit when you add the two to get the combined profit? The combined profit, 9604. 9604. So 9604. So that is the profit that was actually realized. So you can minus, or in this case, you can just add the two. So that's how we come up with the income statement. So I want us in this case to now look at the second part, which wanted us in this case to come up with the statement of financial position. The statement of financial position. So the statement of financial position. So 𝐏𝐚𝐲𝐬 Limited, 𝐏𝐚𝐲𝐬 Limited. So the statement of financial position. So our shillings are actually in thousands. Our shillings are actually in thousands. So we start with the non-current assets. Non-current assets. So the non-current asset you can be able to see there we have is predominantly what? Property, plant, and equipment. So property, plant, and equipment. So of course for property, plant, and equipment, the cost there was actually 50,000. The cost was actually 50,000. But in the same TO balance, we have what we had as an accumulated depreciation by the start of the year, which is an amount of 22,500. So it means we have to remove it. To get the net book value, we have to remove it, 22,500. Then, of course, during the year, there was a depreciation in this case, which we incurred, this one. So this was at the start of the year. But now, as the year went on up to the end, there was that amount, 7,500. So that should be able to give you the value of property, plant, and equipment. So this one comes to 30,000 from 50. I think that is 20. So this should be 20,000. Should be 20,000. So the property, plant, and equipment. So any other long-term or non-current asset is not represented there. So you can have now, in this case, the current assets, So for the current assets, if you look at the TO balance, there's an amount that in this case you're having to be told was in the bank. So there's the cash balance. The cash balance that was actually in the bank is an amount of 3104. So cash balance in the bank, the cash balance in the bank is an asset. So 3104. There's an amount of 3104. Then if we go down, we have, so 3104. 3104. Then you have, in this case, the receivables. So hire purchase, trade receivables, hire purchase, trade receivables, hire purchase, trade receivables by the end of the year. So you have, in this case, hire purchase, trade the receivables, Remember our debtors account. In our debtors account, if you can recall, in our debtors account, we got an amount of, I think, by the end of the year, 113,400. Is it 113,400 in our debtors account? 113,400. 113,400. But in this case, out of this, there's what we call the unrealized profit we computed by the end of the year. So we'll have to minus that to get what can be validly be recovered from these trade receivables. So you'll take 113,400 to minus the URP. This URP you'll end up having to deduct from these trade receivables to get what is actually recoverable. It's like having to write off this amount, the unrealized profit here, to get what is recoverable by the end of the year. So in this case, 113,400 minus 5,400, you'll actually be able to get, I think it comes to 63,000. 63,000. Then, of course, they have given us the balance for inventory at the start of the year. In the TO balance is an amount of 7,500. So is an amount of 70. We've been given also purchases, an amount of 171,000, an amount of 171,000. So we need, in this case, to try and actually see whether we can be able to get what the inventory by the end of the year, because in the additional information, it is not there. We've only been given the inventory at the start of the year, which is 7,500,000. And of course, purchases, which is actually what? 171,000. So of course, you have the figure for the cost of sales. We have the figure for the cost of sales, which in this case was an amount of how much? I think 100 and, so we have 171 as the purchases. We have the opening inventory as 171,000. Then in this case, we had the figure for the cost of sales. We had the figure for the cost of sales. The figure for the cost of sales. So cost of sales, we have it here. So you have this figure here. So this is the cost of sales, both for higher purchase sales and of course what the cash sales. So in this case, we know to be able to get the cost of sales, is equals to opening stock plus purchases minus closing stock. So that's how you normally do it. That's how you normally do it. The opening stock plus purchases minus closing stock. So of course, we have that 174,000 is equals to the opening inventory, which have been given there, is 7,500 plus the purchases, which have also been given in the trio balance, is 171,000 minus the closing stock. So board mass. So you'll be told that in this case, I don't know. So this one will cross the equal sign, come this other side. So if you do the mathematics there, then you'll have these 7,500 plus 171,000 minus 174,000 to be able to get the cost of sales. So the cost of sales here will likely be equal to these two amounts. So 7,500. When this one crosses, it becomes a negative. When this one crosses, it becomes a positive. So cost of sales is equal to 7,500 plus 171,000 minus 174,000. It should be able to give you the value of the inventory by the end of the year. Inventory by the end of the year. So this one is the closing stock, actually. Is the closing stock is what that we are looking for, not the cost of sales, but the closing stock. When it crosses, then you do the mathematics. This one crosses, you get a minus there. You should be able to get the figure for the inventory. So it means for us to get the inventory here, we'll be able to take 7,500 plus 171,000 minus 174,000 So this one comes to 178. So it's 4,500 or something. 4,500. 4,500 should actually be, in this case, be what? Be our closing inventory, 4,500. So hope you've been able to see how we've gotten that. Use this formula here. So you insert, this one is the cost of sales, which is there. The opening stock you've been given in the trio balance. The purchase you've been given in the trio balance. This one is what you are looking for to see what was the closing stock by the end of the year. So when you do the mathematics using board mass, this is what you'll end up having to get. 7,500 plus 171,000 minus 174,000. You should be able to get 4,500 like that. So that's why in this case, you complete that one under, in this case, the current assets. Then in this case, we can go to equity and liabilities. Equity, and you can get the total here. You can get the total here. Then you can go to equity and the liabilities. Equity and the liabilities. So of course, for equity here, if you look at the first item in the trio balance, you've been told share capital of 37,500. So you have a share capital of 37,500. We have a share capital of 37,500. Then in this case, we have retained profits. Retained profit is normally part of the equity. So our retained profits is actually here. You can see it there, 9604. But I think there's a figure for retained profits at the start of the year. Retained earnings at the start of the year was actually 3,500. So it means we'll have to add the two. It will be 3,500 plus that one, 9604. 9604. So 3,500 plus 9604. It will come to, I think, 1404. 14,004 or something. 14,004 or 13,104. It comes to 13,104. 13,104. Like that. Then in this case, there's no any other equity item. So we'll have the liabilities. We'll have the liabilities. So for the liabilities, also, you can just be able to check the trio balance, any item on the credit side. But in this case, sums up to be a liability. In this case, if you look at the credit side, you have, in this case, trade payables. So the trade payables is an amount of 40,000. An amount of 40,000. So what are you getting when you sum? 20,000, 3104, 63 plus 45. 20,000, 3104, 63,000, 4,500. can see you're saying 9604. 9604. This one is 9604. What about this other side? What about this other? It should be the same. It should be the same. 9604. Yes, 9604. It should be just be the same like that. So 9604. So that's how you come up with what the statement of financial position. Statement of financial position. Statement of financial position. You can actually be, I think, I don't know whether you can be able to see down here. I think you can't be able to see down here. Let me just adjust for you a bit. You can't see down there. Let me just adjust for you a bit. As we take a small break. Yeah, so hope you've been able to copy that one. And it is okay now. It is okay now. So there are a few areas here and there which I would like us to be able to touch on, So of course there is a handout which I promised I'll be able to share. So there is a handout on theory, question and answers, which I'm going to share. So I think you'll be able to look at it. Maybe after class I should be able to share, but I have it. So I'm going to share after class. But there are a few areas here and there, so which I need also to be able to highlight, So you can be able to write briefly something about, in this case, accounting for government, accounting for government grants, accounting for government grants. So you can write something about how you account for government grants. So when you talk about a grant here, is like a donation or like having to be funded by the government. So sometimes in this case, maybe you can have like an entity, like in this case, what, a school, that in this case has gotten a donation in form of what, a school bus from the government. Or it can just be any kind of an entity that in this case has gotten a funding from the government. Sometimes the government funds a number of projects. So an entity can end up having to receive government grants. So how in this case will they actually be able to account for them? How will they actually be able to account for them? So you can be able to write this and say, a government grant is recognized. A government grant is recognized. A government grant is recognized only when a government grant is recognized only when there is an assurance, only when there is an assurance, only when there is an assurance. A government grant is recognized only when there is an assurance. A government grant is recognized only when there is an assurance that semicolon, number one, the entity will comply with any conditions attached to the grant. The entity will comply with any conditions attached to the grant. The entity will comply with any conditions attached to the grant, So maybe in this case, the grant is given on the condition that in this case, they'll be able to provide the expenditure of that grant. Or in this case, the grant is given on the condition that only it will likely go to, for example, if it's a school, it will only go to fund the vulnerable in the society. So this condition must actually be fulfilled before, in this case, for example, we can be able to say they can now be able to recognize it in their books of accounts. Then in this case, another condition that should actually be fulfilled here, the grant will be received. The grant will be received by the reporting entity. Will be received by the reporting entity. The grant will be received by the reporting entity. The grant will be received by the reporting entity. So there must be that ascertainment that in this case, they'll be able to receive the funds. And of course, there can be a number of indications as to how in this case, whether they have actually been able to receive. Maybe through the bank statements of the reporting entity, this money might have actually been received. So if it's actually been received, then in this case, they need to be able to do what? Report in their books of accounts, report in their books of accounts. So the grant is recognized. So how do you recognize it now? Let's say, for example, you've received a grant as a reporting entity. How do you recognize it now? So the grant, the next paragraph, the grant is recognized as an income. The grant is recognized as an income. The grant is recognized as an income over the period. The grant is recognized as an income over the period necessary. The grant is recognized. It will be recognized as an income. The grant is recognized as an income over the period necessary, to match them with the intended, or related costs. To match them with the intended or related costs. The grant is recognized as an income over the period necessary, to match them with the related or intended costs over the period necessary, to match them with the intended or related costs. So if in this case it was expected to be spent in the year 2024 and it has been received, they can be able to match those costs they incur for the grant, then it will be recognized as an income. Then in this case, we've been able to say sometimes it cannot be money. Maybe in this case, if it's a school, they have donated a school bus. They have donated what? A school bus. So it can be non-monetary. So how do you deal with the non-monetary? The next paragraph, non-monetary grants, comma, such as land, non-monetary grants, comma, such as land and other resources, non-monetary grants, comma, such as land and other resources, are usually accounted for at fair value. Are usually accounted for at fair value. Are usually accounted for at fair value by recording them as an asset, 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 by recording them as an asset. By recording them as an asset, by recording them as an asset. By recording them as an asset, by recording them as an asset, by recording them as an asset. So this one is supposed to be under International Accounting Standard number 20. So you can be able to indicate International Accounting Standard number 20. International Accounting Standard number 20. International Accounting Standard number 20. So you can be able to write other terms under IAS, other terms under IAS 20, other terms under IAS 20. So the first term, you can be able to indicate government assistance. So government assistance. You can explain what is government assistance or how is government assistance. So you have the first term as government assistance. We've been able to differentiate in this case with government grant. So differentiation within the government assistance and of course government grant. But of course, first of all, in this case, indicate what is government assistance. So government assistance is an action. Government assistance. Government assistance is an action by the government. Government assistance is an action by the government designed to provide. Government assistance is an action by the government designed to provide an economic benefit. Designed to provide an economic benefit. It is an action by the government designed to provide an economic benefit. Designed to provide an economic benefit. Specific to an entity. Specific to an entity. Specific to an entity. Specific to an entity. Specific to an entity or range of entities, or range of entities, or range of entities, qualifying, or range of entities qualifying under certain criteria, or range of entities qualifying, or range of entities qualifying under certain criteria, or range of entities qualifying under certain criteria. Or range of entities under certain criteria, under certain what criteria. So there's a criteria that in this case, the government has actually been able to, for example, maybe define, they can be able to define a particular people, what it may be in the society. Then of course, they provide them with what we call what maybe government assistance. So that won't actually be taken as what, as a grant. So it is just specific to an entity or a range of entities qualifying under what certain criteria. Maybe in this case, they are qualifying because they are maybe what people with disabilities, or people with disabilities. Or maybe in this case, they are what children, or maybe in this case, they are the elderly. They are the elderly. So the government can give them what we call what maybe assistance. So they have actually been categorized under that criteria. So they have that specific criteria. So therefore, they'll be funded, but now in this case, we won't call them a government grant, but now in this case is what government, they get government assistance. Government assistance. Then you can be able to differentiate it from a government grant. So number two, maybe you can now in this case try to define what is a government grant now. Government, differentiated from a government grant. Differentiated from a government grant. So government grants are assistance by government. Government grants are assistance by the government in form of transfers. Government grants are assistance by the government in form of transfers of resources. Government grants are assistance by the government in the form of transfers of resources. In the form of transfers of resources in return for past. In return for past. In return for past or future compliance. In return for past or future compliance. In return for past or future compliance with certain conditions. In return for past or future compliance with certain conditions relating to the operating activities of the entity. 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 Relating to the entities of the activity, relating to the activities of the entity. So in this case, you can see under government grants, this one, the conditions. So you can be able to underline their conditions. They're actually conditions that should actually be fulfilled. The entity will comply with any conditions attached to the grant. So there, in this case, under grant, there's exactly what conditions, but here there are no conditions. It's just what an assistance. An assistance. Having been able to define a particular criteria of that entity. They can give it assistance without any form of what conditions. But with a grant, then the government gives you the money, then they give you, like, for example, condition 1. This is what you must be able to do. Report back to us how you've been able to spend the money. Condition number 2, in this case, you must actually be able to provide this kind of what licensing for us to be able to, for example, provide you with what, with the grant. So they give you conditions under grant to be able to fulfill. Otherwise, in this case, we won't be able to say that is a grant. We won't be able to say that is what, a grant. So it will maybe in this case be what you are calling what, government assistance. It will just be government assistance. It will be government assistance. It will just be government assistance, government assistance. Yeah, so that is what will likely end up having to happen regarding government grants. Then maybe the final paragraph before we move on from government grants, you can be able to write the last paragraph and indicate disclosures. disclosures should be made. Disclosures should be made. Disclosures should be made in the financial statements. Disclosures should be made in the financial statements. Disclosures should be made in the financial statements regarding the accounting policy. Disclosures should be made in the financial statements regarding the accounting policy adopted. The accounting policy adopted. The accounting policy adopted in reporting the government grants. The accounting policy adopted in reporting the government grants. In reporting the government grants, and any unfulfilled conditions. So if there are any unfulfilled conditions under the grant, they should be able to make the disclosures. And any unfulfilled conditions, and any unfulfilled conditions, and any unfulfilled what conditions. So they should be able to indicate in the disclosures. You know, in this case, if it's an entity that is actually so much dependent upon, in this case, what you're calling what the government grants here, it means that if they don't actually fulfill the conditions, subsequently, the next year, 2025, they won't get the government grants because they were given that grant to fulfill conditions. If the government realizes for the year 2024, they never fulfilled, they won't be funded. Let's say, for example, in this case, we are talking about what? Just an example, the county governments are actually called upon in this case to do what? To maybe in this case, prepare their budgets and of course submit as far in this case, they spent their money to the treasury before they are funded. So that is the conditions they must actually be able to fulfill. Otherwise, they won't be able to be funded again the coming year. So if it's an entity, if it hasn't met the conditions, why should it actually be funded further? So therefore, in this case, if there has been unfulfillment of these conditions, whenever in this case they are preparing, let's assume maybe they are published financial statements. They are published financial statements. In the disclosures, they should be able to indicate that in this case, of course, there are these conditions which we never actually did what fulfill. So that basically tries to define the going concern of this entity, because if they won't get the funding in future, they'll close business, they'll close shop. And of course, that is the picture that in this case, the person having to, for example, read these financial statements wants to get, so that he can be able to make what an informed decision about the future of this entity. So if they haven't met these conditions, then it means they have to do what? Make the disclosures in the financial what? Statements. In the financial statements. If they fail to do so, it means that when the auditor comes in, he'll be able to, for example, ask them as to whether in this case they have been able to do what? Fulfill these conditions. If they haven't fulfilled, the auditor will know, because what is having to be published here are the audited financial statements. They have actually been verified by the auditor. So if they haven't, for example, disclosed these what conditions, it means that the auditor will raise questions. The auditor in this case will raise questions, and of course, he can actually end up having to do what? Give about the report, about the financials, because they haven't done what, for example, disclosed. They haven't met the conditions. So that's why in this case, we're having to say that any conditions should do what? Should actually be fulfilled, regarding government grants, So that's what basically in this case, you likely end up having to report on what you're calling what the government grants, the government grants. The government grants. I will end up having to report on what you're calling what the government grants, the government grants. So that's all about government grants. That's all about government grants. So you can write this one. So also we can look at briefly at this one. So financial assets. Financial assets and financial liabilities. Financial assets and financial liabilities. Financial assets and financial liabilities. Liabilities. Financial assets and financial liabilities. Financial assets and financial liabilities. So first of all, in this case, we can be able to indicate the meaning. So what is the meaning of these two? Meaning. The meaning. So first of all, in this case, let's look at the what is a financial asset? Financial asset. What is a financial asset? Then we can look at what is a financial liability. So you can write this about a financial asset. You can write this about a financial asset. It means, you can go to that and say, it means, in this case, number A, what does it mean? Number A, it means cash. So if you have cash, that is a financial asset. So it means cash. It means cash. It means any asset. It actually means any asset. That is, it means any asset. It means any asset. That is, it means any asset. Any asset. It means any asset that is, in this case, number A, cash. Then in this case, you can say number B, any asset that in this case is actually cash. Then number B, an equity instrument of another entity. An equity instrument, like shares, an equity instrument of another entity, an equity instrument of another entity, an equity instrument of another entity, like shares. That's what we mean by that. An equity instrument of another entity, or in this case, C, a contractual right, 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 put a semicolon. If you enter into any contract to do this, what you're going to mention here, a contractual right, put a semicolon, number one, put the dash there, put a dash there, a contractual right to receive cash, a contractual right to receive cash, a contractual right to receive cash, or a financial asset, a contractual right to receive cash, a contractual right to receive cash, or a financial asset from another entity to receive cash, or a financial asset, another financial asset from another entity, then this particular contract here will give rise to what we're calling what? A financial asset. So we'll be able to conclude that is, like in this case, what? Expected future inflow regarding what? A financial asset. Then another one, number two, a contractual right to exchange. Number two, a contractual right to exchange financial assets. To exchange, a contractual right to exchange financial assets. To exchange financial assets. A contractual right to exchange financial assets with another entity. To exchange financial assets with another entity. So you can give examples of financial assets. You can give examples. So you can give examples so that the point can go home. You can give examples so that the point can go home. You can give examples so that the point can go home. Examples of financial assets. Examples of financial assets. So investment in equity. You can say investment in equity. Examples, you can have investments in equity. In equity or in shares. Investments in equity or in shares. We can have, in this case, cash equivalents. So cash and cash equivalents. Cash and cash equivalents. Cash and cash equivalents. Trade receivables. Trade receivables. Trade receivables. So you're expecting future inflow. So you're expecting this cash. So it is a contract to receive the cash because it's a trade receivable. It's a contract to receive the cash from the trade receivable. So that's what a financial instruments. Financial instruments. Financial instruments. Investments in it can be investment in debt instruments. Investment in debt instruments. Investments in debt instruments. E.g., in this case, you can give example E.g. of that one, like debentures. Like debentures. Investment in debentures. So there'll be an expectation of what? An inflow out of this, these, or cash to be received out of these. Those are just the examples. Those are just what the examples. Then now in this case, what is a financial liability? So meaning of a financial liability. A financial liability. Meaning of a financial liability. So number two, financial liability. Meaning of a financial liability. What is a financial liability? So you can say it is a liability that, how does it arise? A financial liability is a liability that it is a liability that it is a liability that it is a liability that a financial liability is a liability that is a contractual obligation. You can just continue. It is a liability that is a contractual. It is a liability that is a contractual obligation. Is a liability that is actually a contractual obligation. Contractual obligation. Number one, to deliver cash. to deliver cash, to deliver cash, to deliver cash or another financial asset, to deliver cash or another financial asset, to deliver cash or another financial asset, to deliver cash or another financial asset to another entity, to deliver cash or another financial asset to another entity, then to deliver cash or another financial asset to another entity, then number 2, to exchange financial assets, to exchange financial assets or financial liabilities, to exchange financial assets or financial liabilities, to exchange financial assets or financial liabilities with another entity, with another entity, with another entity under conditions which are unfavorable, 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 under conditions which are unfavorable. So you can now in this case give the examples. Give the examples. So you can say, for example, trade payables, issue of debt instruments, issue of debt instruments, issue of equity instruments, equity instruments, equity instruments. So ETC, issue of equity instruments, ETC, issue of debt instruments, issue of equity instruments. So you'll likely be under financial obligation to fulfill the terms. You'll be under financial obligation to fulfill the terms. So that is what we mean by, in this case, what a financial asset and a financial liability, a financial asset and a financial liability, a financial asset and a financial liability. So you can be able to write briefly the last thing you can be able to write, derecognition. So of course you're having to say these ones, you'll end up having to recognize them as financial assets because they are, once the contracts arise, you have to recognize them as part of the assets. But now there's a particular point in time whereby now in this case, you'll have to derecognize them. You no longer want to, for example, in this case, be holding shares in a company forever. So when you're holding the shares in the company, during that point in time, you can actually, for example, refer to it as what, as a financial instrument you have. But of course, at a particular point in time, you might sell the shares. So will you still continue to, for example, consider this as an investment that you can be able to call as a financial asset in your books of accounts? It means that in this case, at a particular point in time, they can be what we call what, derecognition. You need to remove them in your books of accounts. You no longer, in this case, have to recognize them as to be part of what, your books of accounts. If in this case, if it's investment in equity or shares, that is an investment you've made, is an asset you have to recognize because there's that's what contractual obligation, expecting, for example, in this case, what maybe an investment or this money to come back. So a financial asset should be derecognized when derecognition of financial assets and liabilities, financial assets and liabilities, derecognition of financial assets and liabilities. So in this case, we can start with derecognition of a financial asset. So you can write and say, a financial asset will be derecognized. A financial asset will be derecognized, derecognition, will be derecognized a financial asset will be derecognized when, semicolon, a financial asset will be derecognized when, semicolon, number one, the contractual rights to the cash flow, the contractual rights to the cash flow, the contractual rights to the cash flow from the financial asset, the contractual rights to the cash flow from the financial asset have expired. The contractual rights to the financial asset have, the contractual rights to the cash flows, the contractual rights to the cash flows from the financial asset have expired. Have expired. Then number two, the entity transfers substantially all the risks. The entity transfers substantially all the risks and the rewards, transfers all the risks and the rewards, transfers all the risks and the rewards of ownership. The entity transfers all the risks and the rewards of ownership of the financial asset, all the risks and rewards of ownership of the financial asset to another party, to another party, to another party, to another party. Then the last one about, in this case, the recognizing financial liabilities. An entity should derecognize a financial liability. An entity should derecognize a financial liability. An entity should derecognize a financial liability when, semicolon, an entity should derecognize a financial liability when, semicolon, the financial liability, when the financial liability is settled, when the financial liability is settled. When the financial liability is settled, that is number one. An entity should recognize financial liability when, semicolon, number one, when the financial liability is settled, that is number one. When the financial liability is settled, that is number one. Then number two, the obligation specified in the contract, the obligation specified in the contract is discharged. The obligation specified in the contract is discharged or cancelled. The obligation specified in the contract is discharged or cancelled, or expires, or cancelled 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 or expires. So because this one is under IFRS 9, that is the financial instruments. So that's where we define financial assets and financial liabilities. Still part of the syllabus. They are still part of the syllabus. They are under the first topic. Under the first topic. So I think we can maybe wind up there. So we can actually be able to wind up there. We can wind up there. Yes, we can wind up there. So I don't know if there's any questions, so maybe you can ask. So we'll meet in the next class. So in the next class, I think we'll handle leases. Then after leases, I think we can do also some questions for group. So I think the other bits, I think about theory, I think I'll be able to share them. I'm going to share them. You can just be able to go through them. There's no problem if you can be able to go through them. So I'm going to share them. If not tonight, tomorrow. When I settle down tomorrow, I should be able to share. Then you can go through the theory parts. So they are not that complex. It's just easy as we've been able to see these ones about financial assets, financial liabilities, about government grants. So there are a number of areas. There are a number of areas. Yeah, so I think we can end there. So we can end there. So unless there's any question, maybe you can ask. So if there isn't, then I think let's end there for now. So we meet in our next class. We'll meet in our next class. We meet in our next class. So I'm not sure whether I'll be able to come in tomorrow. So, but we'll see what will happen. If I won't come in tomorrow, then I think we'll meet on Tuesday, Wednesday, and Friday. Tuesday, Wednesday, and Friday. So, of course, from next week, we'll be so much focusing on revision. We'll likely be so much focusing on revision, on the most likely areas that I will end up having to be tested. So, make sure we have like 3 weeks. Don't actually miss out on what is happening in the next 3 weeks, because time is not really on our side. Don't miss out on what is actually happening in the next 3 weeks. Otherwise, thank you very much. So enjoy the weekend.